Part B of the question. Mauzo Limited manufactures an equipment which requires 4 components, namely A, B, C, and D. The budget production in units and cost for each component are presented below. So we have production units, variable cost per unit, direct materials, direct labor, overheads, total fixed costs in thousands. Additional information is that general fixed cost amounts to 60,000 per annum. Mauzo Limited can, instead of manufacturing the components, purchase one or all of them from a dealer at the price of shillings 24, shillings 42, 20, and 28 for components A, B, and C respectively. Advise Mauzo Limited on the components that should be purchased rather than manufactured internally. So that question is a question from it's a question of November 2018. November 2018, question 3B, and it is a case of make or buy decision. Is a case of make or buy decision. So we have details here. We have a column of details. Now in that one, we will need to bring direct materials costs, direct materials costs. We will also need to bring direct labor costs. We will also need to bring variable overheads costs. Variable overheads costs. We will also need to bring specific fixed costs. Specific fixed costs. When we do that, we will get relevant unit making costs. Relevant unit making costs. We will compare that with external purchase costs. External purchase costs, and then we will make our decision. And then we will make our decision based on that. We will make our decision . Then we have 4 products. We have 4 products. have a table like that, whereby this is product A, B, C, D. If you are finished drawing, you say yes. If you are finished drawing, say yes. Yeah, the key is through. If you can, you say yes. Okay, I think we are through. So we record the figures as given. Materials for A is 8. For B, it is 10. C, we have 4, and D, we have 8. Those are the materials costs. Labor, I have 16. I have 18. There is 8 and 12. Value of overheads, I have 4. I have 6. I have 2, and I have 4. Now for the specific overheads, because they are given in totals, you shall divide. Like now, the first one, it will be 12,000, you divide by 2. The number of units that are given up there. So 12 divided by 2, that gives us 6. This other one will be 10, you divide by 4, and that gives us 2.5. That gives us 2.5. The next one is 12, you divide by 8. That gives us 1.5. The next one is 30, you divide by 6, and that gives us 5. That gives us 5. Then you add those costs. You say 8 plus 16 plus 4 plus 6 is 34. 28 plus 8.5 is 36.5. Then 14, that is 15.5. 29. Those are the relevant making costs. Then you compare that with the purchase price that is mentioned in information 2. A, we can get it at 24, B at 42, C at 20, and this one at 28. Now, the general fixed cost that is given in information 1, that one we shall not consider because a general fixed cost is irrelevant cost. A general fixed cost is an irrelevant cost. So going by these results, you can see if we decide to make A, we will spend 34. But if we go buying, we will spend 24. So it is better that we buy this one. It's better we buy than we make. For this one, if we make, it will cost us 36.5. But when we buy, it will cost us 42 shillings. So this one, it is better we make it by ourselves. It will be cheaper. This one, if we make it is 15 shillings, but if we buy it is 20 shillings. So it is better we make by ourselves. And the other one, when we make it costs us 29, but if we buy it costs us 28. So it is much better for us to buy that item. It is better for us to buy that item. Some factors to consider. This is what I gave you in your notes as non-monetary factors to consider. Non-monetary factors to consider. Non-monetary factors to consider. Now, these non-monetary factors to consider, you remember, we kept on saying effect on fixed costs. Effect on fixed costs. You see, like now we have ignored the general fixed costs because we are taking that they will not change. But we must be sure that that will exactly be so. Number two is effect on staff morale. Effect on staff morale. So what or how does this one, the one, especially this one of mine, how does it affect our staff? Are we telling them that they are not good enough? Number three is alternative use. Alternative use of resources that will become idle. Resources that will become idle. Alternative use of resources that will become idle. When you decide to buy, you will now be free. You will be free. Your space will also be free. So what can you do with that? So I think those are enough. For more, you can check in your notes. I think I gave you almost 5 or 6. And that would be good. So are we okay with that question? If you are okay, type okay so that I bring the next question. Simon is okay, Vicky is okay, Brian okay. Maureen. Okay, the next question on the line is a question that was tested in November 2017. Go there. November 2017, question 3. That's the next one that I want to deal with. So the question of November 2017. Question number 3. Question number 3. So that question says that Epitech Academy has been using their own van to transport students to and from school. The new principal feels that this arrangement is costly and proposes that the school hires out transport services. The school accountant has provided the following data: cost of the van, annual insurance, annual repairs, driver's monthly salary, annual road license, TLB levy per annum, scrap value of the van, tires and tubes annual expenditure, inspection cost per annum, petrol cost per kilometer. Additional information is that the van is estimated to cover 20,000 kilometers per year. It has an estimated useful life of 6 years. A new traffic rule has been issued requiring all passenger vehicles, including school vans, to be fitted with speed governors and seat belts. These will cost shillings 120,000. The school plans to apportion this cost over the useful life of the van. Hired monthly transport will cost 253,000, out of which 210 is attributed to the van. The driver will earn a salary of 25,000, while the conductor will earn shillings 18,000 per month. Now advise the principal of Epitech Academy on whether to use own transport or hired transport services. So let's deal with own transport. Own transport. So this question is coming from a topic known as service costing. So we deal with the case of own transport. And I told you when you are in service costing, the first thing is to classify costs. So we have the fixed costs. We have the fixed costs. So the fixed cost that we shall have is, first of all, depreciation. And maybe we need to specify own transport per year. We are working per year. So the depreciation is we are not told at all about the residual value, but we are told that the vehicle, I can see it down there, scrap value. So depreciation will be 3,500,000. You less the residual value that is down there, 800,000. Then we are told this van will be there for 6 years. So you divide this by 6. So do that and give me the figure for annual depreciation. Do that and give me the figure for annual depreciation. Yes, according to Alfred, is that 450,000? Yeah, 450,000. So the annual depreciation is 450,000. Okay, good. The next thing they had mentioned about speed governors and seats. We have speed governors and safety belts. Safety belts. We are told by information 2 that this will be 120 and will be allocated over the useful life of the vehicle. So it will then be 120,000 you divide by 6. That is also a fixed cost. 120,000 you divide by 6. How much is that? Yeah, good. I can see 20,000 coming. 20,000, that is the... Then there is annual insurance. Annual insurance. Now, annual insurance is an amount of 345,000, which is fixed. There is annual repairs, that is also a fixed cost. Annual repairs. So annual repairs, 220,000. The driver's salary. The driver's salary. We are told it is 45,000 per month. So you take 45, you multiply by 12. Uh-huh, 540. I have one figure from Maureen. I need several figures. Let's be sending our figures. Yeah, good. 540,000. 540,000. The next one after that is annual road license. Annual road license. So annual road license is 50,000. It's 50,000. TLB levy. TLB levy per annum is 54,000. 54,000. Scrap value, that one we already have dealt with it. Tires and tubes expenditure. Tires and tubes expenditure is 63,000. 63,000. There is inspection cost. Inspection costs, which is also a fixed cost of 5,000. I think that is all for the fixed cost. So we bring the variable cost now. We bring the variable costs. And the variable cost that is there is petrol. And petrol, we are told it is 68 per liter. And you can see that according to information That is per kilometer. According to information 1, the vehicle is covering 20,000 kilometers. 20,000 kilometers. So give me that figure. 68 times 20,000 is an amount of how much? $1,360,000. So when you add this, you get the total cost for all transport. I think I can even create something like this so that I compare the two of them at the same time. So add all of them. $3,107,000. $3,107,000. Okay, let's get the total costs of hired transport. Total cost of hired transport is $253,000 per month. $253,000 per month. $253,000 per month. So multiply that by 12. Multiply that by 12. $36,000. 3,036,000. So what would you tell them? Should they use their own transport or they should hire? According to the results here. Yeah, good. They should hire transport. They should hire transport. Part B of the question. So the question is service costing in CVP. analysis so that I now bring part B. The following details were obtained from the books of Talbot Limited, a manufacturing company. Variable cost per unit, fixed expenses, selling price per unit. Now we are told to get a break-even point in units. So break-even point in units. Break-even point in units. I told you the formula of getting that. XBE is given as F. You divide by the contribution margin. And the fixed cost, we are told it is 1 million. We are told it is 1 million. And then contribution margin, we know is the selling price, which is 500. You minus the variable cost, which is 300. You minus the variable cost, which is 300. So give me the answer to that. What would be the, yes, I can see one answer. I need at least 3 so that I can write. The second one has come. I need another one, good. So 5,000 units. So 5,000 units. Then tunaambiwa the selling price per unit if the break-even point is brought down to 4,000 units. So that one we can call it new selling price. New selling price. So the new selling price is going to be given as 1 million. You divide by P, which you do not know, minus 300, and the answer is 4,000. And the answer is 4,000. So solve that and tell me what is the value of P. If we want the break-even now to be send me the answer. Skiza hapo. Yeah, good. Naona mko sawa. Jamal. Okay. So how is supposed to be done? You argue like this. It will be 1,004,000 P minus 300. So this is 1 million. You open the brackets and get 4,000 P minus 1.2 million before. So putting right terms together, we have 1 million plus 1.2 is equals to 4,000 P. This is 2,200,000. 2,200,000 being equal to 4,000 P. And when you divide this 2,200,000, you divide by 4,000, you get P. That is the one that is giving us P as 550. P as 550. So Jamal, okay, good. Now we have gotten everyone. The next thing is, if the present sales volume is 4,000 shillings, compute the margin of safety. So margin of safety, is MOS is equals to R minus RBA. So R, we are told that the sales volume is 4 million. So the break-even point in shillings is 5,000 times the selling price of 500. The selling price of 500. When you want to express the break-even in units in terms of shillings, you just multiply by the selling price. So give me the margin of safety there. $1.5 million. 1.5 million. Good. I can see those answers. So we are okay with that. And based on that, I wish to proceed to look at the next question. So the next question I want us to deal with is a question of May 2017. May 2017, question 1B. Get there. The question is a case of cash budget. It's a case of cash budget. May 2017, question 1B, a case of cash budgets. So if we are there, the question reads that Taxon Limited manufactures a single product branded PS. The management accountant is in the process of preparing the budget for that quarter for the year ending that 1st of December. The following information is available: production and sales. The unit variable cost breakdown is as follows. We have materials, labor, and variable overheads. Selling price per unit is 8,000. The monthly fixed cost amount to 1.6 payable 1 month in arrears. The labor costs are paid in the month incurred. Suppliers of materials give 1 month credits. Variable overheads are paid for in the month following production. Sales of 50% of sales are on cash basis. The balance is paid the following month. The opening cash balance for the month of July is estimated at 5 million. A machine bought in May and that is due for payment in July. So you are told to come up with a cash budget. You are told to come up with a cash budget. So as I told you, when you see a cash budget question, it is important you start with the column called details, where number 1, you bring in or you identify the receipt items. The items that are bringing money in. And from what we have read, it is very clear. We have sales, and according to information 8, we have cash sales, which are 50%, and therefore it means we have the credit, which is also 50%. We have credit, which is 50%. So from what we have read, I have not seen anything else that is bringing money in. I have not seen anything else that is bringing money in. So we therefore get something called total receipts. We get something called total receipts. And these total receipts, we normally designate it as A. Then we bring the next part of the cash budget, which we know so well is called payments. It's called payments. And in regard to the payments, when you look at information 2, you can see direct materials. So we will be paying direct materials. That is for the suppliers. We will also need to pay direct labor. Those are the wages. We need to pay that. That will be a cost. We will also be needing to pay variable overheads. Those are cost of production. Variable overheads. Then we will have the monthly fixed costs. The fixed cost, that is according to information number 4. Number 5 talks of wages, which you have addressed. Number 6 talks of materials, which you have addressed. Number 7 is really a variable overhead. You already have brought that. Number 8 is sales, which you have done that. The opening balance will come in later. Then we have a machine that will be paid for. We have a machine that will be paid for. That will be paid for. And that is all. That is all. So if that is all, then we get something called total payments. We get something called total payments. So the total payments, which is designated as B, thereafter we now bring what we call balances. So regarding balances, we have surplus, stroke deficit, and if it's a deficit, it is negative, which will be arrived at as A minus B, you call it C. A minus B, you call it C. Then we will have the opening balance. The opening balance, and you call it B. And then closing balance. And closing balance will be C plus B. Closing balance will be C plus D. So sasa hii unafunga hivi. Unafunga hivyo. And then you divide it into 3. Divide it into 3 because you're told to do for 3 months ending September. So we are dealing with the case of July, with the case of August, and with September. With September. September. When you finish drawing, you say finished, so that from there we proceed together. Yes, finished. Good, good. So what we shall do now is we shall be taking the sales units. Like for the first year, no, for the first month, July, sales were 1,500. So chukua 1,500 multiplied by the selling price of 8,000. Selling price of 8,000, and then get 50% of that. And send me the figure. $1,500 times 8,000, then 50% is 6 million. Good. So 6 million is cash. Then tunaambiwa the balance is paid the following month. So in August, we will be paid the balance. Let us go to August and do the same thing. August, utasema 1,800 times 8,000 times 50%. Send me the answer. Yeah, I can see one answer. Waiting for the others. Yeah, good. 7,200,000. And the balance will be paid in September, 7.2. We do the same thing with September, 2,000 times 8,000 times 50%. That is 8 million. And that the other one will be paid now in October, which is not part of our budget. And the question has not informed us of what was sold in June. So then that means here our total receipts is 6 million. This is 13,200,000. And this is 15,200,000. 15,200,000. What now you do for the materials, you take the units produced. So in July, the units produced are 1,700. Multiplied by 1,500. And we are told suppliers, according to information sheet, they give us credit of 1 month. So give me the figure. 1,700 times 1,500, umepata ngapi? Yeah, 2 million. So that amount will be paid the following month, 2,550,000. So this month, there is nothing that we are paying. Then for August, we shall pay, rather we go to August where production was 1,900. So chukua 1,900 times 1,500, you get 2,850,000. That will be paid for in the month of September. That will be paid for in the month of September. So what was paid for what was incurred in September will be payable in October, which is not part of our budget. Next is direct labor. Direct labor, according to information 5, we are told that it is paid as it occurs. So, utachukua the units produced 1,700 times 1,000. And that is 1,700,000 here. 1,700,000 there. In August, it is 1,900,000. And in September, it is the same thing, 1,900,000. 900,000. For the variable overheads, according to information 7, we are told they are paid for in the month following production, so the next month. So if we are paying next month, utasema 1,700 times 500. 1,700 times 500 is 850. So here unalipa hapa the following month. And then 1,900 times 500 is 950,000. 950,000. The next one is the monthly fixed costs amount to 1.6 payable 1 month in arrears. So because this is monthly, it is monthly payable 1 in arrears, inalipwa next month. But we also have to pay in July for the month of June. For the month of June, because this is not a new business, it's a business that is continuing. It's a business that is continuing because we are told the management accountant is in the process of preparing budgets for the 3rd quarter, for the year ending. So they have been operating for the 1st quarter, 2nd quarter. So now we are making budget for the 3rd quarter. So in the 3rd quarter, we will pay 1 million here, 600,000, 1,600,000, 1,600,000. That is what we shall pay. And then there is this machine that will be paid for in July, 5 million. So in July, we are paying for a machine, 5 million. So we start now adding. We get the total payments. So this will be 8,300,000. This is 6,900,000. And this is 7,300,000. Then let us get the deficits. So 6 million minus 8,300,000. There is a deficit of 2,300,000. Second month, that is a surplus. There's a surplus of 6,300,000. That month, there is also a surplus of 7,900,000. And then we are told by information 9 that the opening cash balance was 5 million. So we opened with 5 million. So if you have that means you close with 2,700,000. And 2,700,000. So this is 9 million. Then 9 million. You have 16,900,000. 16,900,000. Are we okay with that? Okay. Have you finished copying? Okay. The next question I want to add though, the one that I can be able to finish within the next few minutes. Is the question of September 2015. September 2015, question 5B. September 2015, question 5B is on cost bookkeeping. Cost bookkeeping. So let's go there. September 2015. So if we are there, the question says, I'm dealing with 5B. We are told to prepare those accounts. So let's open them, then we will read as we record. The first one is stores control account. Stores control account. Then we have another one called finish. Finished is not a big one, so I want to put it down here. Finished goods account. Finished goods account. Then there is another one called work in progress. So work in progress account. And the last one is production overhead account. Production overheads account. When you finish drawing, you write the word drawn. You write the word drawn so that you can still start reading. Okay, you can see we are finished. Good. So the question says that Raga Limited operates an interlocking accounting system from the cost account. The following information was available for the month of July. Opening balances for the store's control account. So kuja hapa useme balance brought down. Balance brought down is 108,500. Balance brought down 108,500. Work in progress pia hapa useme balance brought down is 178,200. And finished goods hapa balance brought down is 84,150. Then we are told transactions for the month is that cost of finished goods were that. So when goods are finished, they are finished from the work in progress, because this is where production takes place. You finish them here and you remove them here, you take them to the finished goods account. So we will go to the work in progress and credit it because of the finish. Because of the finish, and we record 1,024,100. 1,024,000, that is what was finished. Then we come to the finished goods because of work in progress. Work in progress, it is 1,024,100. Those are the goods that were finished, were completed. Then cost of goods sold. When we sell, we remove from the finished goods and we take to the cost of sales account, which is not part of our requirements. And in a question like this one, you just confine yourself to what is required. So these goods will be removed from here. So I think because of cost of sales, 986,920. So we will credit there. If we had the cost of sales account, we would have debited, but I've said we don't open what we have not been asked. Direct materials issued. When you issue materials, you are removing them from the store's control account and taking them to where work is happening or production is taking place, and we are told they are direct materials. So we can start with the stores. We say because of work in progress, tulipeleka 395,500. Then we go to the work in progress. Because of the stores, we received 395,500. We received 395,500. Direct wages. When you have direct wages, you debit work in progress and credit wages account, which is not present in our case. So here we will debit wages to show the labor cost. Direct wages 170,960. 170,960. Production overheads as per financial account. So when you see as per the finance, that means it's what was paid. Finance are the ones who pay. So when we pay, we debit the overheads account and credit bank or finance. So because of the financial ledger, here we paid 440. That is what was paid. When you pay, you debit the overheads account and credit the financial ledger control account, which is not part of our requirements. Direct material purchases. When we buy materials, we debit stores and credit finance. So let's go to stores. We debit it because of the financial ledger. Because of the financial ledger of 433,180. 433,180. That is what we paid for. Then we are told in the cost account, depreciation was 25,000 per month. So that depreciation is part of production overheads. It's part of production overheads. So we will debit here because of depreciation and then credit the depreciation account, which is not part of our workings. 25,000. 25,000 there. Production overhead is absorbed at 250% of wages. So when you absorb overheads, you debit work in progress and credit overheads account. So we will say here, because of work in progress, the amount of absorbed overheads are 250%. 250% of the direct wages. And the direct wages is 179.60. So work out that and give me the figure. Work out that and tell me. Oh, good. You can see Brian 427,400. 427,400. And that amount, yeah, good, I can see all those. That amount, we bring it here. Because of overheads, 427,400. 427,400. So from there now, we close the accounts. So this one, there is nothing that has gone to the overheads. So we should have now balance carried down, which you should get as 108,500 plus 433,180 minus 395,500. That closes at 146,180. As the balance carried down, then we do the same with the finished 84,150 plus 1024,100 minus 986,920. The balance carried down is 121,330. 121,330. Then we go to the work in progress and do the same thing. Balance carried down will be 178,200 plus 395,500 plus 179,60 plus 427,400 minus 1024,100. I'm getting 147,960. That one you close. And finally, this one will be 440 plus 25,000 minus 427,400. So this is an other absorption that should go to P&L of 14,040 shillings. So that is all that we can manage for today. When you finish, you say finished, so that I can be able to end the session. Thank you so much for attending the lesson. Have a great day. We continue preparing for the exams, although day by day it's becoming a bit doubtful whether the exams will be there. But for now, we are still preparing and hoping that it will be there. We are still waiting for the communication from CASNEP. But for now, let's prepare. So I can see we have finished. We are finished, and therefore we can end the session. Have a great day. See you in the next lesson. Thank you.